All right, well, thank you so much for being here and making time out of your busy days. My name is Libby Bretthauer, and I'm the city's finance director. So we've been working on this project for about a year now, and as you'll hear later as we go into some background, it's a long time coming because we haven't really done a comprehensive look at our business license tax in about 50 years. So we're very pleased to have all of you here in person today, as well as about 30 people on Zoom. So we are recording the session, and it will be posted later on our city website for anyone who missed it or if you'd like to refer back to it. So now I'd like to introduce our Chamber of Commerce President and CEO, Jill Lampkin, to say a few words too.
Thank you so much, Libby. This is really strange to be on this side of the on this side of the dais.
Yeah.
Thanks, you guys, for coming. And I'm going to give a public service announcement right now that my email got hacked about 15 minutes ago. So if you do get an email from me, please do not open or click on anything. Someone's in my office trying to fix that right now. But just so everyone knows, I wanted to get that out there as well. I could not be more thrilled about this meeting today because as those of you in DBPA know, I started with Steve Shirillian when I first joined the DBPA about 6.5 years ago. We started talking about this and how complicated the business license tax code was and how there was so much disparity between small businesses and large businesses and 9 different ways to calculate the tax and how difficult it was. And it's been a long journey. The wheels of government do not turn quickly, but I could not be more thrilled with where we have come. I sat through the presentation with Libby yesterday and Emmy Rose, and I think it gives a lot of valuable information, but most importantly, I want to thank the city and the finance department for allowing the businesses this opportunity. You are going to have the opportunity to take a look at 4 different options, and based on your business type, vote for what you think is the best option for you. And that way we have data that we can go back to City Council with when this gets presented to them in May. So I am so thankful to you guys for all of the hard work. Thanks to the entire department. I know it was not an easy job and it was not a quick job. So thank you very much, and I appreciate you holding this forum for us.
All right, thank you, Jill. And then I will go ahead and introduce Emmy Rose Hanna, our financial services manager, who's been leading our team. We have had a big team working on this, including Tony Page, our revenue services supervisor, Josh Grady, our lead account specialist, and John Albee, our management analyst. So it is a pretty big undertaking for the city, but we are very excited to move this forward.
Absolutely. Thank you, Libby and Jill, for the introductions. Again, I'm Emmy Rose Hanna, the Financial Services Manager. And as Libby shared, it is a team effort to gather the information and bring this forward. And we're just so excited we're at this point where we're able to share this with the business community. So thank you so much for everyone attending and joining this Business License Tax Forum, the first of its kind. Those that are joining via Zoom and in person in the council chamber, we thank you for attending and your participation. So as we begin our presentation, really wanted to highlight the agenda for today's forum. It's going to include a few elements, and we're going to share, some background and history on the city's current business license tax and really dive into the current tax structure that we have in place. From there, we're going to look at the 5 primary goals of our business license tax modernization plan. And then thereafter, we'll see a list of 20 individual priorities that are broken up into 2 phases. Phase 1 is just administrative cleanup of the code that was already completed at the March 3rd public hearing at City Council. Phase 2 is currently underway, and that's the stage that we're currently in and seeking community input on Phase 2 priorities, which trigger changes to the tax structure, and thereby they trigger voter approval. And then later on, we'll be able to transition the presentation to our business license tax consultants with HDL Companies. We have Eric Myers, our managing director, attending via Zoom, and he'll present the preliminary results of the tax study and explore different tax alternative structures that will be presented before council and before this group today. And then lastly, we'll touch on the next steps in the tentative timeline in the weeks and months ahead. So just to add a little bit of background, the main purpose of a business license tax is mainly to ensure that businesses are complying with local regulations and also for a way to contribute to public services because they do benefit from our clean and well-maintained streets as well as our safe and secure community. And the business license tax supports the general fund, which helps contribute to the overall quality of life here in Manhattan Beach and the atmosphere that makes the community so attractive for business owners to operate to residents and to visitors. Some further background on the basis of a business license tax. So typically, the tax is assessed on gross receipts. However, there are instances where it could be a flat rate or a per employee rate, per number of vehicles rate. It could be assessed on square footage. It could even be assessed in a combination of all of those factors. And so just to share a few statistics, over 95% of cities in California impose a business license tax. On average, business license tax makes up around 3% of city revenues. Here in Manhattan Beach, we generate roughly 5% of our general fund revenue through our business license tax. Some cities generate up to 20 to 30% of their general fund revenue through this tax. So we're, on the lower end, and we'll share some more insight as we look at the comparisons later in the presentation. And so with that, we wanted to dive into the current structure of our business license taxes. So as Jill alluded to earlier, there's over 9 different ways in which the tax is currently assessed upon our different businesses. And so this will be familiar to our businesses since we are currently in our business license renewal season. The renewals are due April 30th, just as a reminder, but it'll be very familiar to those that file. And the 9 different ways, essentially the most common way is based on gross receipts, and that's assessed for in-town businesses in addition to home occupation and out-of-town. There's also a flat tax, which is only a flat tax assessed on contractors, subcontractors, and P.O. box businesses. There's a per unit, per room tax that is assessed on hotels, motels, and apartments of 3 or more units. There's also a per vehicle tax that's applied to gardeners or mobile vendors. To continue, there is also another tax structure on a per employee basis, and this is for administrative and sales offices. There's another category where it's simply just square footage basis. And then for our commercial property owners, this one is a hybrid. It's whichever is higher. There's a square footage basis calculation or a gross receipts calculation. Whichever is greater is what is used to calculate the tax. Similarly, for research and development, there's 2 options, and it's whichever is greater. And in this case, it's based on square footage or the number of employees. And then lastly, we touch lightly on the supplemental licenses, which is a handbill or solicitation, so advertising, flyers, and things of that sort. So, currently, there's 9 different ways that we assess this type of tax, and it's a little complex, maybe more complex, especially for our newer businesses, but it can also be complex for our existing licensed businesses, since there are so many ways in which the tax is assessed upon the different business types. So with that being said, one of our primary goals of this effort will be to try to simplify the tax structure so that it's not so complex and it's easy to understand and digest for all businesses, new and existing. And with that being said, in our next few slides, we'd like to engage in our audience with an interactive polling question. Having just seen the 9 different types of tax structures in the last slide, we're curious as to what tax structure your business currently falls under. And to participate in this question, you would simply scan the QR code in the next slide and it should display now. So we welcome all attendees, both in person in council chambers and for those attending via Zoom. So you simply scan the QR code and it'll allow you to participate, and the results will actually display in real time. So it looks like we already have some responses in, and it's, continues to grow. But this is really insightful because it shares with us the types of tax structure that you currently are paying into. So we'll give a few more moments to have everyone make their selections, and we'll be able to see the results. And it looks like gross receipts is the leading contender here, but we do have commercial property. We have one that does not know which structure they fall under, and that's okay. And that's the purpose of, we want to simplify the process so that you do know and it is clear as black and white. All right, so looks like we have about 20 responses, and a majority of our businesses are paying gross receipt basis. So that's really helpful as we navigate these next few steps and the next few slides. So thank you for everyone in participating. So a bit more on our current tax structure. One area of focus is to understand the city's current business license tax cap, which is the maximum a business pays on their tax. So as you can see on this slide, as a business gross receipts increases, which is on the left-hand side, you'll see that so does their payment, which is in the middle column of the table, but only up until they reach the cap. And so the current cap for this current business licensing year is about $12,156. The current cap means that you would generate roughly $4.5 million until you reach that cap. So based on this cap, any business generating higher gross receipts would pay the exact same as a 4.5 million business. So a 20 million business or a 10 million business pays the exact same amount. And so, another primary goal as part of this effort is to look at fairness and equity across all the business types. And then another interactive question in the next few slides is to help us understand the impact to our audience. We are curious as to what threshold your business currently falls under. And with that, you can scan the QR code in the next slide. And I wanted to share that the responses here are entirely anonymous, and the individual results will not be displayed or given. And to participate, again, you just simply scan the QR code, and we'll be able to see where the results come in. And we'll give a few more moments for everyone to make their selections. Okay, so we have a nice mix of different thresholds that are submitting responses. So that's really helpful as we navigate the rest of the presentation. Awesome. Looks like there's a couple more responses coming in. All right, so, biggest grouping is in the lower range, the 100 to 3 million, 100,000 to 3 million range. But again, there's a wide mix of businesses that operate in the city, so we want to really share this information with all groups, all business types, all thresholds. So thank you, everyone, for participating in this poll question. All right. So the last piece we wanted to share regarding the history of the business license taxes here in Manhattan Beach is that the code was created back in 1971. And it really hasn't changed much since then, other than a few minor amendments over the years to add new categories and things of that nature. However, so much has changed in the last 50 years, where there have been shifts with how businesses operate and new industry types have emerged over the years. And so really a comprehensive review of our current tax code is warranted and is why we're here today. So with that, we wanted to touch on the main outcomes of the business license tax modernization plan. And those outcomes are focused on 5 primary goals. And these goals were developed by taking into account the feedback that our team has received over the years from the business community on concerns, questions, issues, complications that we've, received feedback, over a period of time. And these goals mainly aim to simplify, clarify, and modernize the code, allow for a more fair and equitable tax structure, in addition to maintaining fiscal sustainability for the city. So in these next few slides, you'll see that these 5 primary goals are embedded and help shape the 20 individual priorities and action items as part of this overall plan. And so with that, I will add that if you attended the March 3rd public hearing at City Council, the information on these next few slides is going to be very familiar. To recap, we grouped the 20 individual priorities into 2 phases. And phase 1 was essentially administrative updates and refresh of the language of our code that could be accomplished through a code amendment and ordinance. And so that phase was already completed on March 3rd with a second reading on March 17. The main focus of today's presentation is for phase 2, which has 10 additional priorities that actually look at the tax structure and do trigger voter approval in a ballot. And so we're here today to seek your input and engagement on that process. So with that being said, we won't go into detail on phase 1 since it's already been adopted and really has been shared prior to this meeting. And then if you're curious as to what specific code sections were modified and cleaned up as part of that phase 1, this slide here shows all of the individual sections that were refreshed and modernized. And I will add that a lot of outdated text in the code was needed to just reflect our current practices. So one example was the due date for your business license renewals was not showing, it was not reflecting the April 30th date that was reflected on everyone's renewals. So we codified that so that it matched our current practice. So now that we are at the stage of phase 2, we really wanted to share the 10 individual priorities within phase 2. So priority 11 here is to update the business categories based on the business type rather than their location. So as an example, we'd consider eliminating the home occupation and P.O. box category and instead assign them based on their business type. So if it's an accounting agency or some type of professional services, it would fall under that category rather than a home occupation or a P.O. box. Priority 12 is to simplify and consolidate the tax types based on gross receipts, as some businesses currently pay on a different basis, as mentioned, the 9 different ways, the number of employees, the number of vehicles. So really looking to streamline and simplify it to a uniform gross receipt basis. Priority 13 is to clarify and expand the professional services and real estate categories, and also create new business types that have emerged and just did not exist 50 years ago when the code was written. Priority 14 is to clarify the category for short-term rentals versus hotels. So currently, hotels pay a per-room business license tax, whereas short-term rentals pay a gross receipt basis. So we would like to uniform the tax basis for both. And that's to reassess the best practices to ensure fairness. Priority 15 is to consider a standard deduction or a adjusted threshold for the business license taxes. And then as we continue with phase 2, our 16th priority is to consider changes to the current sales tax credit that's only available to commercial property owners. So currently, the way this works is commercial property, during their renewals, they're able to receive a credit for the sales tax generated by their tenants. However, the tenants do not have an option of receiving the credit, and the credit is based on sales taxes generated by individual tenants. So again, this comes back to the focus of fairness and equity and reassessing that current credit. Priority 17 is to address apportionment by eliminating or reducing the flat tax and also clarify exemptions and deductions for revenues generated in other jurisdictions and cities. So for anyone attending today that's not familiar with the term apportionment, we wanted to clarify what that means. So it is the process of allocating your gross receipts for your business generated in the specific city. And so as an example, one business could operate in 3 cities. Let's say they do business in Manhattan, Hermosa, and Redondo Beach. Well, they only need to report their gross receipts generated within the city of Manhattan Beach's jurisdiction. They wouldn't report gross receipts generated in other jurisdictions. So that's the nature of apportionment. Moving on to priority number 18 is to clarify the definition of employees to include both on-site and remote employees, since the nature of telework has drastically changed since COVID-19. And then also 19 is to evaluate the current tax rate structure in comparison to our neighboring and comparable cities. And I will add that later in this presentation, HDL will show a comparative analysis of the tax rates in 7 other cities. And then lastly, priority 20 is to research and reevaluate the current business license cap, which is currently at $12,156. And with that, I will transition the presentation to HDL. We have Eric Myers, our consultant managing director, that'll lead us through the tax study and the preliminary results and comparisons. And he'll be joining shortly.
Thank you, Emmy. Can you hear me okay?
Yes, we do. Thank you.
Okay, great. So this afternoon, we're going to present the tax study roughly in this order and as the answer to 3 key questions. What is the city's current structure in broad strokes, which covers our registry analysis? How does that structure compare to a selected list of peer jurisdictions, which will be the jurisdiction comparison section of this presentation? And then what are the 4 alternative models that the study presents as ways to address the policy priorities that Emmy just covered with you? So next slide, please. So we will be focusing here in very broad strokes on what is your current tax revenue system from the perspective of business license tax. Now, as you can see here, over the last 4 completed years, so the last 4 bars on the right side of this chart, the city has seen moderate growth year over year in terms of business license tax revenue. Next slide, please. We see similar growth patterns in just the number of registered businesses. So the blue line are businesses that have a physical location inside the city of Manhattan Beach. That gold or yellow line are businesses that come in from outside the city to do business here and conduct taxable activity in the city. And you can see that there's been growth over the last 4 years in both categories. Next slide, please. Now, as was already really presented, I think, very well by Emmy, there's a lot of complexity in the structure of the tax code right now. This particular slide just sort of breaks down the current rate types into the top rate types, and then as you'll note, in the next to the bottom line, you'll see all others. There are 17 of these rates types that we haven't listed out individually here. And then on the far right, you can see the primary tax basis for each of these. So how is your activity measured? What do you pay on? Whether it's flat fee and gross receipts, or sometimes per unit, et cetera, which Emmy already covered in a great detail earlier. So here, we wanted to take a look at, sort of viewed through the lens of the business license tax revenue, we can see that the economy, a little bit of the shape of the economy of Manhattan Beach. So we can see, for example, that retail sales and service, followed by commercial property, professional services, restaurants, and then general contractors make up a good portion of the business license tax revenue and the current tax base for the city. Next slide, please. This chart is, I think, most helpful for understanding the impact of the cap on the current structure. I see that we have a hand raised. I don't recall, Emmy, whether we wanted to save those to the end or respond as we went along.
Yes, thank you.
It's so hard to,
Sure.
I mean, I'm taking a picture and then I'm trying to enlarge it on the phone.
If
Your font is so small.
Absolutely. I'd like to clarify, we will have this PowerPoint available on our website in addition to the recording. So for I see a few members in the audience taking pictures of the slides. It will be on our business license webpage. To answer your question on the reading of the information, absolutely, Eric can verbally kind of describe the content that's on the slides and the comparisons that we're looking at. So thank you. And then lastly, we will be opening up the forum for Q&A and public comment towards the end of the presentation. So kindly, if you have any questions, if you could hold them to the end so that we can address everyone's questions and inquiries as it relates to these slides. So thank you.
Thank you, Emmy. So on this slide, we're looking at the 3 donut charts. Starting at the left, top 100% of the total reported, so top 100 as a percent of the total reported gross receipts. And the colored portion represents about 85%, whereas the gray portion, it's a navy blue, and the gray portion represents the remainder. So top 100 businesses report about 85% of your gross receipts in the city. In the middle, we look at that same view of the top 100 businesses as a percent of the total reported employees, which they are, again, this sort of teal color represents about 12.5% of the reported employees are reported by the top 100. That is likely just an artifact. Oh, okay. I will continue to describe what I'm saying until we see if we can fix the unavailability of slides online. So thank you for letting us know about that. The top 100% in this far right chart, again, a donut chart, showing that about 35%, almost 36% of the total tax revenue comes from the top 100 is 35, almost 36%. So in other words, the impact of the cap is that while the top 100 businesses report about 85% of the gross receipts that could be taxable, they are currently paying about 36% of the taxable receipts for the city. Next slide, please. So In the next few slides, we'll compare how the city's current tax structure compares to a selected set of peer jurisdictions. As Emmy mentioned, 7 cities that we put into the study here. The 7 cities are Beverly Hills, Culver City, El Segundo, Hermosa Beach, Redondo Beach, Santa Monica, and Torrance. Now, this table, it's a little busy, so if you don't mind, I'm going to walk you through it here a little bit. You can see the city of Manhattan Beach falls almost exactly in the middle. There's 3 cities below it. Those are Torrance, Hermosa, and Redondo Beach. And above it are Santa Monica, Culver City, El Segundo, and Beverly Hills. How did we rank those? Well, if you come over to the middle of the chart, there is a column called revenue per capita, which is simply the business tax revenue divided by the population. So we see how much revenue per person is being generated by the current business tax structure. And you can see that that is how we've actually ranked these cities in this table. And Manhattan Beach on that measure falls right about in the middle. It would fall right about the same place also for revenue per business in its current structure. A few things to note here. If you come over to the tax structure last modified, this third from the right column, you'll see that the last time there was a significant structural change to this ordinance was 1976. Okay? And then you can also see that of the peer cities, Manhattan Beach is the only one with a cap. The rest do not have caps. Another way of looking at the table, at the data underlying the table, and I think this is a little bit easier to follow, but we've got 2 charts on this slide. The leftmost is a comparison based on per capita and per business. And so we have in the dark or navy blue, the revenue per capita. Again, that was the number we were just talking about, and you'll see that Manhattan Beach falls number 5 out of the 8 there, right in the middle. Or excuse me, yeah, 5 out of the 8. Whereas revenue per business, Manhattan Beach falls about the same. That's the more teal, the lighter blue here. That gives you, again, just a visual sense of where the city sits, which is roughly in the middle at the moment of the peer jurisdictions. What percent of BLT is contributed to the general fund? Again, Emmy mentioned this before, with it being at about 5% for Manhattan Beach, which again puts Manhattan Beach about in the middle in terms of the revenue stream produced for the city to provide services, et cetera, from this particular tax structure. Some cities are more dependent on it, others less so. Okay. Now we'll get into the actual models themselves. So having looked at the current structure and situation, let's go ahead and dive into the 4 alternative models that we've mentioned here. What are they? What are their basic structures? What would some of their outcomes be? Next slide. Thank you. So model number 1. Model number 1 is a simple modification, and that is it maintains the current structure, so it doesn't really modernize or simplify, but it would remove the cap on gross receipts and keep everybody where they are. So effectively, Model 1 just removes the cap. We want to see what impact would that have. It does increase equity somewhat, as Emmy mentioned before. When you remove the cap, you're going to alter the effective tax rate for the larger businesses, but it doesn't simplify the tax structure and really doesn't address maybe new business models that may be evolving. Next slide, please. So model one, based on our models, and just to mention the methodology, we essentially take the charges from the last completed year and build out that as the model and say, if we had applied this new model to the historical payments from last year, what would we have seen in terms of revenue? So that way we're not building in assumptions about the economy or other forecasted items, but looking at past behavior, what would have happened if we had applied a different set of tax rates there. And here you would see about 2.9 million. So you've seen, oh, you're okay. Go ahead to the next slide. Thank you. So you've seen here a variation on this chart, and you're going to see it again and again. So I'm going to spend just a minute with you on this chart. So in the leftmost column, we have the gross receipts at those different tiers or levels that Emmy mentioned before. And right next to it is a column with the current business license tax payment based on gross receipts. So we're assuming that these businesses would be paying on gross receipts now, which a majority of you that were able to participate and respond to the prompt earlier are paying on. And you can look at the different sort of tiers of what the tax rate is now. Next to that, in the middle of this table, is the current percent of gross receipts. And you can see that that goes to about 28%, and then the cap kicks in under the current structure, and then the rate begins to decrease. Next to that is what would the Model 1 business license tax payment be? And you can see that it's the same up to about 4.5 million. And then because of the removal of the cap in Model 1, you see the increases along with, in the rightmost column, the stabilization of the effective tax rate, it being the same for everyone above that threshold once the cap is removed. So that's where you get the equity from, if you will, from removing the cap. It's also where most of the revenue comes from in this model. Okay, next slide, please. So next model. Model 2 is a single gross receipts rate, meaning that we tax everyone uniformly. There's a single rate. I believe in this model it's $2.80 per thousand. That rate applies to everybody, which means really we now have just two categories, non-exempt and exempt. So everybody, and then those that are exempt by law. It has a small flat rate tax, and then it removes the cap as well. Why did we consider this model? Well, it's fairly easy to understand and calculate. Doesn't really matter what kind of business you are as long as you're not exempt. It's all the same rate for everyone all the way down. And that makes it a little bit more equitable and easier to understand. It has a low flat rate that supports micro enterprises, maybe some side business or something you're doing at home, and increases revenues for city services. Next slide, please. So here's the basic structure of that model along with the revenue impact. So at the top table, we have the basic structure. You have a flat rate that decreases from where it is today, has a $100 flat rate, and that covers up to the first 100,000 in gross receipts. So if you make 50,000, you pay the 100. If you make 100,000, you pay the 100. It's just a simple flat rate. And then over that 100,000, it's $2.80 per thousand in excess of the 100,000. How would that impact revenue from today? Again, if we applied this to the historical reporting, we think about $2.3 million in extra revenue to the city for additional service support. Okay, again, we'll come back to this particular slide. What is then the impact at these different levels? And you can see here, again, that where it really starts to impact is the removal of the cap, but you also have decreases. So at 100,000, the current business license payment would be 337 here in the second column from the left. It would be $100 in Model 2. For 500,000, it's currently about 1,457. It would be approximately 1,220. So you can see this slight decrease until you hit where the cap would impact today, and then start seeing that pick up with the cap. More equity, a lower rate for the smaller businesses because of the lowering of the flat fee. Okay, next slide, please. Model 3 is very similar to Model 2. It has its own sort of logic here, but what it does is it increases it, as compared to Model 2, where we had just eliminated the cap. The big difference with Model 3 is we keep the cap, but we increase it to 100,000. That's essentially the difference here. We're going to go ahead and say, well, what happens if we keep the cap, but increase it from around 12,000 today to 100,000? Next slide, please. So again, rate structure should look very familiar. Other than the cap, it's essentially the same rate structure as Model 2, and the revenue impact is about an additional 1.1 or 1.2 million to the city, we would estimate. Next slide. So let's look at that again from sort of these different levels of gross receipts for a business. Again, for the 100,000 or 500,000 in gross receipts, you see the same lowering of the rate from the current area over 4.5 million. You begin to see the impact of the moving up of the cap, and then at the 50 and 100 million range, you see the cap being the new cap kicking in. Now, roughly a business would reach the cap of 100,000 in payment. I think I said 100 million before, 100,000. A business would reach this cap once they earn about 35.7 million in gross receipts. And so right in between that 20 and 50 range is where the cap would kick in, as you see here. Next slide, please. All right, our fourth and final model is different than the others that we've seen before. It's a variable gross receipts model. And in this model, we do retain some of the complexity, meaning we have a simplified but varied gross receipts rate by certain broad categories of business. And then we keep the small flat rates tax. The cap stays at 100,000 compared to, say, Model 3, where it was also 100,000. And we get, as I mentioned, we reduce the number of categories to about 5 broader categories. So it's easier to navigate to a certain degree, keep some of the advantages of the Model 3 as well. Next slide, please. So the rate structure here is we'd have the 5 simplified categories, which are contractor, general retail, professional, property rental, and services. And general retail would pay $2 per thousand. The other categories would pay $2.80, same rate as was put forward in Models 2 and 3. The $100 flat rate applies as it did in Models 2 and 3 as well. Next slide, please. We estimate that would impact, in terms of revenue output, about an additional 500,000 or so from this model. You can see that if you read across, for example, in general retail, just the second line in the table, the estimated number of businesses we think that would be classified in this group what we estimate their taxable gross receipts just overall are, what the charges were in 2025, which is the 1.7 million that's coming from that group, and then if you applied the new model, how would that result in revenue here? All right, next slide, please. So here we're going to actually split, because there's two different rates. We're going to look first at this grouping, which is sort of the everybody else grouping, and then we'll look at retail. So this grouping, again, for the smaller businesses, a decrease. You see that all the way up to the 4.5 million again. And then you see you've got an extended cap. So we see that behavior again in the results here. Same kind of rates as you saw before. And so nothing too surprising there. Again, you'd hit this cap at about 37 or 35.7 million. Next slide, please. For general retail, because the rate is at $2 per thousand, you see actually some decrease a little bit farther up. So if you looked at 5 million, for example, you would see that they're also having a decrease from even the capped amounts right now. And then you start to see the increase up to the 100,000 payment cap. Again, you would see the impact at roughly, I think it's in the 50,000 range. About 50 million is where you would begin to see the impact of the cap. So just over 50 million, you see the impact of the cap. All right, let's go ahead then and compare the models and their outcomes in certain scenarios, just to give us some more context. So first, let's take a subcontractor. So you can see here, and each of these slides will be structured this way. So we have the category, they're a subcontractor or contractor. We have some assumptions about gross receipts or employees and square footage. And just to be clear, none of these are real. There's confidentiality around business license tax. So these are completely hypothetical businesses that we're using to help say, well, given this hypothetical business, what would they pay in Manhattan Beach now and under the models that we've discussed? And how does that compare to the 7 cities that we've used as the comparison group? So for a subcontractor, current tax, 246. Model 1, no change. Models 2, 3, and 4, that drops to 100. Right now, Manhattan Beach is the leader in this area in terms of the tax and would fall to the middle position and be nice and securely in the middle for the comparison cities. Next slide, please. So for restaurants, that's our example 2 here. So we've got this hypothetical restaurant. It would be classified under model 4 in the general retail. Gross receipts, just an assumption of 600,000, 8 employees, and 2,500 square feet. Current tax is the highest, 1,696. Again, because this is below the cap, Model 1 does nothing to change that. Models 2 through 4 drop it, with Model 4 dropping it the most because of the change, the general retail rate at $2 per thousand. How would these models stack up? Well, you can compare. Restaurants are at the highest right now of the comparison group and would remain at the highest. However, Model 4 or something like it would close that gap pretty significantly, dropping almost $600 of annual tax out of that. Next slide, please. So we chose, for this example, a medical office. They would be classified under the professional category under Model 4. Gross receipts, assuming about 1.2 million. 5 employees, 3 of them being classified as professional, and about 3,000 square feet. Current tax applied to this hypothetical would be 3,315. Again, you're below the cap, so Model 1, no real change. Slight drop under Models 2 through 4. Here you begin to see that currently and under the models, Manhattan Beach would be it'd be in the 4th range, I think. So Beverly Hills would be higher, Culver slightly higher, Santa Monica, so right about where your position is today. And finally, example 4 would be commercial property. And under the commercial property, we've got a few things to note. So models 2 through 4 would eliminate the sales tax credit for the commercial property. And so that's part of where you're seeing some of the increase in revenue as well, is in that elimination of the sales tax credit for the commercial rental properties. Now, and why do that? Frankly, to address the tax and structure it more along best practice lines, as well as improving fairness and equity. Where is the tax rate now? About 11,745. Again, there's a credit here typically, or to some degree. Each of the models that we've discussed would have a significant increase here, but note that while they're about twice as high as Culver and Santa Monica, they're nowhere near as high as Beverly Hills, which has a significant amount there. And so this would jump up for commercial property to being sort of second on the list. And one of the things it does, I should note, and we can stay on this slide, but for commercial properties, the changes in models 2 through 4 as studied would move, again, everyone to the gross receipts structure, so it would remove the square footage based tax option from the current structure. All right, next slide. So this slide just sort of summarizes high level all 4 of the models that we've discussed. Model 1, just removing the cap, and you can see at the bottom of this table, again, that's about 2.9 million in projected additional revenue. Model 2 would both remove the cap and reduce the flat tax, and impact of that about 2.3 million. Model 3, again, what it does is reduces the flat tax. It keeps the cap, but moves it to 100,000. That would likely produce about 1.2 million, a little bit less, for the city in additional revenue. And then Model 4 reduces the flat tax, sets the cap to 100,000, and sets a variable gross receipt rate, and produces, we estimate, about 500,000 in additional revenue to the city. And with that, I'm going to turn it back over to Emmy.
Thank you so much, Eric, for walking us through the business license tax study, the results, and some of the examples on how it would impact businesses at various levels. And so in these next few slides, we have an interactive polling question as to which tax model you might prefer. But before we allow everyone to vote on which of the 4, we wanted just to pause if there's anything that you need clarification on before you move to vote on which model you like. So with that being said, if we could pass the mic, or feel free to step down to the podium, and you're welcome to address the audience with your question.
I could ask lots of questions, but I'll start with removing the cap seems, I think, makes intuitive sense to a lot of people, but have we addressed why was there a cap originally, and what are we doing to preserve whatever motive they had in the first place?
That's an excellent question. Without having the history of the 50 years and being in place when it was originally formulated, the likely scenario was to encourage economic development and encourage business-friendly incentives to bring large-scale businesses in town and offer an incentive and a cap to the largest set of businesses. Over the years, we've heard feedback that it's not as fair, that someone making double is paying the same tax. And so we're here today to address it with the community and really assess it as part of the tax study and present some viable options that could bring some more fairness. So that's an excellent question. We scratch our heads on it as well. But for whatever reason in the past, it was established with the cap and likely due to economic incentives and economic bolstering economic activity within the city.
I wanted to comment on that too. It's a good question, John. If you think about what $4.5 million was in 1970, it's a much different scenario than what it is now too. And if you go back and look at, we're the only city that has a cap, and it's probably because it was written 50 years ago. So that, I don't know if that helps answer, but I think when they put that cap on, it was probably such a massive number that they were like, wow, if somebody does more than $4.5 million, great, we'll get so much money out of them. And now, obviously, that's a totally different scalable number.
Yeah, that's a great point, Jill. And the cap does move every year with CPI, but like you said, the businesses we have, there are many who blow past that, and there's about 100 who exceed that.
Thank you. Next
Kathy
public-
Winterhalter. I've got a bunch of questions because I couldn't ask as we went along. Okay, the 100 top businesses that you guys kept talking about, are those people making over 4.5 million, basically? Okay.
Yes, that's what we mean. When we
And then, does that include the commercial properties?
anyone who reports over 4.5 million in gross
Okay.
receipts.
Was the purpose of changing all this to raise more revenue?
No, that was not our original intention. We started on this path to update our code that's so outdated. There were so many items in the code that just outdated language, everything we addressed at the beginning. There's a lot of background and history that just our internal team, we get asked the same questions over and over from businesses. We have to constantly explain certain, very distinct language in the code. And so our original intention was to clean up some of that language, clean up and modernize our code. So that's where we started. So of course, though, to do this endeavor, we have to have some basis for what we would look at. And so that's why the city hired HDL, who's considered the experts in the business. They've done similar studies all across California. And so rather than just come with one option to city council as revenue neutral, we did want to see, since we have this issue of the cap that's no longer considered a best practice, we wanted to see what various options were, and that's how we landed on 4 with different ranges in revenue to the city.
What is a non-exempt business? What is that? Who are those people?
So that includes nonprofits, banks, who am I forgetting?
Now,
Religious institutions.
so
Yeah.
banks don't pay any but business license?
Correct.
And that's a federal thing? Or a City of Manhattan Beach thing?
Eric, do you have an answer on that one?
I do. It's both state and federal. Both the federal and state have preempted the right to tax financial institutions of certain types, including banks.
Are money managers part of that too? Are they exempt?
I
Curious.
wouldn't be able to give you an exact answer. My approximate answer would be likely not if they're private money managers. It just would depend on whether they meet the definition of financial institutions under the exemption rules.
To clarify, money managers, financial advisors of that nature would be classified as professional services, and therefore they are assessed a gross receipts
Okay.
tax.
And then another thing I just wasn't clear on. Okay, the gross receipts thresholds where you said, which, I'm noticing what applies to me. 3 million, 4.5 million, what were those thresholds based on? If you're going to go to some of those models and keep those thresholds, I saw some of the models that didn't matter anymore, but there, if I took the notes right, there were some models where you kept these thresholds?
If I could add, so the thresholds are not tiers of tax structures. They're simply examples provided to everyone in the audience so that you could see where you
got it.
align with
Got
and
it. Okay.
what's closer to your gross receipts basis.
Okay.
So they're not threshold-based tax structure. It's just an example.
Okay,
Yeah.
thank you.
Thank you.
Kathy, those were excellent questions.
Hi, guys, Maureen. Couple quick questions. The count of businesses, it appears that contractors, retail, and commercial property were all pretty significantly increased over the last count that happened in, I think it was 21 to 25, like through 21 and then to 25. Contractors increased 67%. I combined them, so if I did the math right. Retail up 50%, commercial property up 58%. So what attributed to that increase in the community? Because it's very significant. Yeah, these numbers here.
I don't know if we've looked at that specifically, but we could theorize
Just
on
curious,
that.
'cause it's-
I don't know if.
Those are big numbers.
They are.
Well, if you look at 2020 to 2021, think about what that was. That was COVID.
No, I get
So,
it. I
yeah, so
understand
I'm
that.
just saying, people weren't building then, and so that is going to be a huge disparity
fact that we've
between,
more than
it's a
doubled.
funky word, I mean, a funky year that was chosen, just because that is COVID. So I wish we knew what it was in, 19 to 20 or 18 to 19, because it might not have been such a drastic change.
Yeah.
Yeah.
So
We
anyway,
could
just,
definitely
it's
look at
just
that.
throwing it
Yeah.
out there. I'm curious,
No, it's a
Absolutely.
great,
what it was.
great question.
Great observation. So maybe when we present this to city council, we could have
Might be
other
something to look
numbers for
at.
context.
In looking at, all of the scenarios, it appears that the 3 or 4 lower ranges, like up to the 3 million, there's minimal changes in pretty much all of the scenarios, and most of the big changes happen beyond the 3 million. And so I just think, again, that's something to look at when we're looking at the parity of what happens with larger businesses to smaller businesses. My concern when you were showing like Model 4, there's a huge increase, obviously, to commercial, but one of the things to think about, and I don't know if this is what would happen or not, but would those costs then get passed along to the tenants? So that's very concernful that, yeah, maybe that looks real good right now on paper, but how are those costs going to be absorbed by the commercial properties? And are they then going to extend those out to their tenant base? So that would just be something to look at there.
Could I just clarify? I'm so sorry. This might not have been addressed during this slide. So currently, commercial property, there's 2 bases of tax. There's a gross receipts and a square footage, whichever is greater. This example is just using the gross receipts basis. But if the square footage of that commercial property resulted in a higher tax payment in the current tax structure, then they would pay much greater. So that's the one exception to the cap, is if it's commercial property or research and development. And so there are commercial properties that pay well above the current cap of the 12,000. And so in some cases, it would result in a net decrease as well. So there's going to be some increases, some decreases. It really depends on what they currently pay now. And if they would be set to the new cap, then they may result in a lesser payment. So just
Okay.
wanted, thank you.
And then also on scenario 4, when it said general/retail, is that including restaurants in with the retail number?
Yes.
Okay, so that's doing that. And
As
that
well as
just-
hotels.
And hotels also? Okay. And then last question, just regarding gross receipts from a retail standpoint, a lot of us, if not all of us, do discounting throughout the year. And so, we're paying on gross receipts, yet we're actually not taking in that much money because we're discounting. We're offering 10% off during events or 20% off during certain times of the year where that gross number does not include the discounts. So that would be something to look at for sure for retail. Does that make sense? Is that making sense the way I'm
It
articulating
is. I was going to
it?
ask if, Eric, you wanted to chime in on, that is a question we've been asked before, is why gross receipts and not net receipts? Eric could you address that?
Sure, I can. I mean, that's a great question. Thank you. So the one thing we have to be really careful on gross versus net is that the state has made it really clear that they are the only ones in the state of California that have the right to tax on net income. So a business license tax has to be on gross income. And that obviously when you've got lower margins, that has an impact, right? So, but that is kind of a no-fly zone under the state's rules of the net income tax can only be assessed by the state and not any of the local taxes.
And just as a follow-up, could there be a line item or something on our business license taxes where the retailers can show their discounted amount because it all comes out as a line item for all of us, that can be adjusted in some way, or is it just not possible?
I think that's also one of the reasons why we included that Model 4 with the discounted tax basis of $2 instead of $2.80. So I would think that would also capture some of what you're, in a different way.
Doing $1 million a year and you discount 20%, that's $200,000 that you did not take in income, but you're having to pay tax on, business license. So something to look at.
Yeah, thank you.
Hello, my name is Ezra. Thank you for letting me speak. Just one thing that's, in one situation, we have a building that we own and that we also operate. So we get 2 business licenses for that building. So it's not, we don't think that's fair because we're basically paying rent to ourselves, and then we have to pay twice for the same business. So that's one thing, and I agree with what everyone else has been saying in that if you consider everything on gross receipts, then yes, you could be losing money and increasing your tax burden, and that's difficult it's already difficult for retailers to survive here, and so I don't think it's beneficial to make it more difficult, but I mean, in certain, I wasn't able to absorb all the changes from the Model 1 to Model 4 and which one we would prefer, but I would like a lower tax for the people that are operating in the city so that they could put money into their businesses. Thank you.
Thank you.
Looks like we have one more question here in the audience, but I don't know do we also have any hands raised on Zoom?
No request on.
Okay, go ahead, please.
I was wondering if we had considered or why we would not consider a reduced tax. So removing the cap, but reducing the tax as they graduate to $30 million in revenue, $50 million in revenue. I don't know what limits we currently get to, but so that the larger businesses don't feel like they're being just taken advantage of, because absolutely they're a very important part of our community and business model. And then also among the four choices presented, I didn't see any that I thought were really, really exciting. Is there a place where we can vote for, we'd like to see something a little different than these four options?
We're certainly open to other feedback and ideas. Again, we hired, expert consultants, and these are in line with what the tax structures are in other cities and more modern tax codes. But if you have other ideas, we'd be welcome to hear them.
Well, yes, and no offense to Eric, he made a very thorough presentation, but it does feel like, I think there might be more, pretty broad approval of removing the cap, taxing more to businesses with higher revenue streams, but, and probably a flat tax for, or a smaller flat tax for the first 100,000 sounds like a good idea. We could combine kind of those things, but I don't feel like this was particularly tailored to Manhattan Beach. It may be very similar to the other cities, but Torrance and Beverly Hills aren't much like us.
Is it possible for us to ask Eric about that? To say, are there other tax structures that are wildly different than these, or is this kind of standardized? I'm guessing, I shouldn't guess, because I don't know. I'm not an expert in this, but
Yeah,
I would love
absolutely.
his opinion
So
on that.
we did discuss the potential of a progressive tax structure similar to income taxes. But Eric, are you able to weigh in? I can't see his face right now, but.
I am able to weigh in. So, I appreciate the thoughtfulness of the question and the critique. What I would say is part of what we're trying to do with the tax study is make sure that we are future-proofing. As we've seen just since COVID, the evolution of business models and how people are conducting business. What we want to do is have some models that are tied as closely as possible to the taxable business activity, and gross receipts is the gold standard for that. Most of the other creative models that I've seen are actually higher taxes on specific kinds of businesses within a specific economy. And that bakes into your revenue for the future the assumption that everything's going to stay the same for the next 50 years, which, if we know anything, that is not going to be true. And so what we're trading off here, which again, it's a good, well-reasoned critique. What we're trading off here is the ability to adapt to the future, the fairness and equity, and then with a progressive tax structure, definitely I've seen those. They've gained some popularity in the Bay Area, for example. They tend, however, to do the opposite of what the speaker so eloquently stated, which is a truly progressive tax structure tends to ask the largest businesses to pay even more than their fair share, which these models were saying, how about we adapt and make sure that it's a level playing field for small, medium, and large, or closer to level in any event, given some of the other policy objectives. I don't know if I answered that question well. What do you think, Libby? Can I give some more detail, or what would you like?
I was also looking at the initiator of the question to see if he had any follow-up, but I think that was helpful.
That certainly is helpful. It would be nice to know if the structures that he's picked out are helping to legally proof us against future challenges, or if there is another kind of goal in mind for choosing these particular structures, or if these are just kind of a couple of ways that can work out, but we could make changes to it.
Could you hear that question, Eric?
I could, and both parts of that question and comment are great. So to the first part, gross receipts is, in our opinion, the gold standard and a growing structure in the state of California, and arguably already the majority. I think people that have per employee are falling behind. I think you have a neighbor, El Segundo, there, that's got some dependency on per employee. As we watch what happens with AI and some of the outsourcing and automation, I think we're going to continue to see that trying to tax on an input like labor doesn't future-proof you. So from a solid perspective, yeah, gross receipts helps you both with the future and with, hey, this is what a better best practice is to have this unified structure. So I'd say on that, and then as far as the rates themselves, I think that's the kind of feedback that we're hoping to hear, and we're welcome to hearing from the community, is just what are the thoughts on the rates? The rates have they're meaningful within the context, but they're not sacred. They can be adjusted at this point in a study. And so any insights that anybody wants to share around that, we would be more than happy to hear.
All right, thank you. So I think we have one more comment here in the meeting, and then maybe we'll advance to the next slides.
I'm not sure if I've seen this on the slide or not, but like for the retail, like LA business tax, they give you like the first 100,000 they waive. Do you guys have that for the city of Manhattan Beach?
Could you clarify, are you coming from another jurisdiction and you're
Yeah,
curious as
well,
to how that would work here?
Yes, I do business city taxes for other cities too, besides here. But like for LA City business taxes, for retail, the first 100,000 they waive. So does Manhattan Beach have that in the proposal?
Thank you for the question. So under the models 2 through 4, we actually introduced a pretty large reduction to the base tax to be more business friendly for small businesses, micro enterprises. What that does is it takes the base tax from $300 and change down to $100. What that $100 covers is the first 100,000 of gross receipts. Okay. So any business starting off that is estimating up to 100 or maybe even less, they pay the nominal flat tax of 100,000. Okay. Anything beyond that then is paid an additional gross receipts basis tax, which is the $280 per thousand in gross receipts beyond that $100. So we did consider removing the base tax altogether, the flat tax, but it would inadvertently result in several categories not remitting anything or getting licensed. And so therefore, best practice is to keep a flat tax that's a very nominal amount of the $100 to get them through the first 100,000.
And what do you do with non-taxable? Do you include that on part of your gross receipts?
If you could clarify in terms of non-taxable.
Let's say if you have clients that are ordering stuff, but you drop ship to another state, and so that's non-taxable. Is that part of the gross receipt, or do you exclude that?
Thank you for the question. I may defer to Eric Myers for that question. That may be an apportionment related because it's out-of-state jurisdiction sales of your services. So,
yeah, the short version is we'd have to talk about details to get a reliable answer. But generally speaking, if your place of business in Manhattan Beach is the place that you're shipping from, and then you put it into the general stream of commerce from there, then this is the participating location, and the tax would be the Manhattan Beach tax, because we don't tax business license on the basis of where the consumer is, but rather where the taxable activity, which is conducting business, took place.
Thank you.
Thank you.
Thank you.
And I understand we have a few hands raised on Zoom.
Yes, the first question is from Patrick.
Hi, thanks for taking my question. I'm a little disturbed that we didn't come in with a revenue neutral proposal. The assumption seems to be that we should be taxed for bringing or doing business in Manhattan Beach without regard to sales tax that we collect and pay, payroll taxes, state and federal taxes, service fees that we're now being charged. So at a minimum, this should be a revenue neutral change, not a revenue grab. And to hear that a $500,000 increase is deemed acceptable, that troubles me a lot as a business owner in the city.
Thank you, Patrick, for the feedback. I do want to share that Model 4 does have a reduction to the general retail, and that's to account for, taxes, supporting the local economy and sales taxes that are generated from those industries. So that is the most revenue neutral model of the four. And in general, the current business license tax structure incorporates an annual CPI, which would be consistent with this type of an increase anyways. So in a sense, it is the most revenue neutral option that it was available. And so hopefully that Model 4 option with the reduced gross receipt rate for general business could help with that relief that you mentioned. So hope that answers your question.
Next question is from Olivia Hunt.
Hi, thanks for taking my question. My question is regarding a vote. Are we voting on which proposal to enact during this meeting? Or did I misunderstand that? And then secondarily, is it only an in-person vote if it is a vote at all? Or is it just, and if so, how do the Zoom participants vote? Thank you.
Absolutely. Thank you for the question, Olivia. So after we conclude public comment, the goal is that we would do the one last poll of the session, and it is available to all attendees on Zoom and in person in council chambers. So it will be similar to the first two polling questions, where there'll be a QR code displayed on the screen, and we'll begin that in just a moment, where everybody viewing this presentation will be able to vote, and the results will be displayed in real time. And we're, going to take that information and report it back to our city council, and they will be the ones to really narrow down the options and take the feedback into their decision-making process. So I hope that helps clarify. The next few minutes of this forum will be making that vote.
I think we have one last comment, raised hand on Zoom.
We have two more. Next one is from Don Zis.
Hi, good afternoon. I just wanted to say, first off, for those that were watching online, when Eric was speaking, there was no slides available. So being able to follow the four methods verbally just by description was pretty difficult. So it would be, at least from my perspective, it would be really hard to weigh in on what would be the right means, because there was no visual cues there to be able to explain what was, how each method was. Secondly, regarding commercial property, my understanding of the way it works is all of the individual businesses at that commercial property already pay your tax, your VLT. On top of that, the landlord is going to end up paying a VLT too. And that also gets spread out to those tenants at that property. So they're already effectively double taxed, if I'm not mistaken. And the majority of these folks are small to regional sized businesses, mom and pop franchisees. And so you really want to be careful about, additional taxation when they're already getting double taxed. Thank you.
Thank you. Eric, would you like to comment on that, on why it's set up the way it is?
Yes. I think it was Dawn was the commenter's name. It raises a good point. We want to be very sensitive to the cost of doing business in California in general, and all of the great business community that is there in Manhattan Beach. And personally, I'm a big fan of the entrepreneurial spirit and what the businesses bring to the table for a community. That said, I think there's a distinction to be drawn. So the landlords, if we don't tax landlords because they will pass it on through their contracts, then the landlords effectively get a tax break that no one else gets in the city. And while I suppose that could be a legitimate policy choice, that is definitely not best practice for how to structure the tax. And then secondly, when you do spread out some of these taxes, as was mentioned, they definitely still have an impact where we want to be thoughtful about them. But that is done by private contract. That's the landlord telling the tenants, I want you to pay my tax. And so it's not the city saying we're going to tax the tenants twice. That's really the landlord saying, I don't want to pay my tax. I would like my tenants to pay it like a triple net, for example. So just those points of clarification, but it is definitely something that I know the city is thoughtful about, as it is with its full business community.
Next question is from Tony Nierico.
Hello, can you hear me okay, fine?
Yes.
Thank you. I just wanted to follow up on, Maureen brought up the point originally, but I think the past questioner just brought it up as well, and Eric attempted to answer it. But the part that's unclear, and it sounded, I'm not sure if it was you, Libby, described in the way those commercial property owners will get taxed, partly on revenue or partly on square footage, I guess whichever is the largest. In some cases, again, I'm at a little bit of a disadvantage because those of us on Zoom didn't get to see the slides, but it seemed like in one instance, those commercial property owners' taxes were going to increase substantially, like by 2 times is what I think I heard in the discussion. It would be hard to believe that a landlord would not pass that on to the small business. And so I think that really needs to be, I mean, it's going to be hard to vote on what I like better. 4 sounds good to me. However, if that substantially increases the taxes on our landlords, we are, pardon my French, but we're screwing ourselves. So that needs to be addressed somehow in 4. And it would make it more palatable if we really understood the impact. If I'm a property owner, my taxes are going up a few $100, that's one thing. But if they're going to double, there's no way they're not going to pass that on. And if that gets passed on, you guys all know, and Jill, you know it better than anybody, the small businesses are suffering right now. Rents are out. Our costs are rent and employees. That's our costs. And if they go up any higher, we're going to drive more businesses out of Manhattan Beach. So that's my comment, my point. Thank you.
Thank you, Tony. And our apologies. We thought the slide showing issue was resolved early on, so I'm sorry if it wasn't showing for the entire presentation. The slides will be going on our website right after this, as well as the recording. And for anyone who would like the slides emailed, you could please email us at businesslicense@manhattanbeach.gov. So is that all of the Zoom comments that we've had, Josh?
We have one more question that came through in the chat.
Okay.
From Sergio Rodriguez. His question is, would HDL be handling business license tax renewals for Manhattan Beach going forward? If so, would HDL take a percentage or commission on those renewals? If so, can you generally speak to their fee structure?
I'll take that question. So the city does partner with HDL to provide the online business licensing payment portal that we implemented last year. However, they do not take a percentage of the taxes received or anything like that. It's a contract based on the renewals, per renewal. So absolutely, no, our consultant does not receive any cut or take on the percentage of our tax issued. But if, one more quick comment, but we would like to conclude with the voting so that way we can wrap up and do the last session, or last slide.
Yeah, I'll try to be brief. I wanted to make a point of clarification that there were two different things that people mentioned that seemed like taxes going up. And one was every plan includes either removing or increasing the cap, which is why none of the plans are revenue neutral. All of those would have higher taxes on the larger businesses, which is one issue. The other issue is, it really stuck out to us when the slide in Plan 4 said commercial property would now be taxed 5 times as much. I realize that was just one example, but yeah, all of us are alarmed, not just concerned, that you might drastically increase commercial property taxes. Thank you.
Thank you.
All right, thank you everyone for all of the feedback and the comments and really great questions that you posed today. In our next stage of this forum, we'd like to open up one last interactive poll where we would like you to vote and share with us which tax model you prefer of the 4 options that were presented this afternoon. So with that, if you can begin by simply scanning the QR code displayed on this slide, and it will allow you to choose of the 4. Model 1, which is no cap. Model 2, which is a cap with a reduced flat tax. Model 3, with a reduced flat tax and a cap of $100,000. And then Model 4, reduced tax for flat tax, the cap set at $100,000, and a variable gross receipt tax for our general business and retail industry. And so we'll allow a few moments for everyone to make their selections so we can see the results in real time. And again, we encourage everyone in attendance on Zoom and in person to vote. For those on Zoom, we hope that you see the slides and the QR code on display. If you do not, please share a chat if it's not displaying for you on your end. All right, so we have 10, 11, the responses are growing. So we have 11 responses, 12. All right, not seeing much more activity. Oh, we got another one. It's so interesting to see it pop up in real time, be able to see where kind of the needle moves. But we do have a mix kind of all 4 models, and we'll absolutely be taking this back to City Council. And I shared this, that we will be going to Council on May 12 and presenting all of the feedback through the polling that was conducted through this forum, so that they can make an informed decision as to which tax model best suits the city and the business community. I will add just some of the next steps and the tentative timeline. We're currently at the stage of the tax forum. On May 12, we'll present the same presentation as this afternoon, where HDL will present the results of the tax analysis, the jurisdictional comparisons, and we will present the feedback from this meeting. And from there, in May and June, our consultants with Team Civics will be conducting a statistically valid community polling regarding the appetite for a ballot measure assessing one of the, 4 models. And the results of the polling will then be presented to City Council at a later time in this timeframe. And then in July and August, there will be a call for the election. A special ballot measure will be placed with the county. And then from there, the last piece is on November 3rd. The general election will take place, and that's where voters will have this ballot measure presented before them on the ballot. And then I just want to add that in this middle step, based on the community polling that's done, if the polling is successful, then the next steps would proceed. But if the polling is not successful, then the process would pause and it would be reassessed at that time. I also wanted to add that all future updates will be added on our business license webpage, so be sure to check back for updates on the process, on the next steps, on the future city council meetings where this topic will be discussed. And I also wanted to share on our website, we'll make this PowerPoint available on that page so everybody can re-look at all the slides, and a recording of this forum will also be made available on that page. So just wanted to share that with everyone in attendance. And with that, we did allow for time for a Q&A, but I think we shifted earlier so we can get some clarification before we voted. So I just really wanted to thank everyone for joining this first ever Business License Tax Forum. And those attending in person and virtually on Zoom, you're welcome to ask any further questions at this point if you would like for additional public comment. If not, and you'd like a more one-on-one question, we are all here for you. We have our business cards presented at the tables outside of the council chambers. So if you have a unique, specific question on your business, we're happy to walk you through your question as it relates to your situation. And with that, thank you everyone for attending this afternoon, and we hope you got a lot of information and are just happy that we're at this stage and able to share that information with the community. So thank you.
Can I just ask a quick question?
Absolutely.
Is it possible for, for Kelly as, in charge of the DBPA and Jill in charge of the chamber, for those QR codes and those, the entire presentation to somehow go out where they would send it out to our individual, teams?
I just asked that because
that weren't able to come on Zoom and weren't able to be here today because you're hearing from such a small part of the community, and we talk about it all the time in meetings and talked about it for 20 years. It's been a really, really long time. So, I don't want to say that the attendance was low, but
So what we just talked about was that the QR codes should stay live. So if people look at the presentation, they can still vote. We won't be able to see it live, but it will be recorded.
Yeah, and it just won't show the real-time results because it's in the past, but you can still, businesses can still use the QR code to submit their preference.
And I would love that. I would love if we had 1,000 people respond because it's really hard, we don't want to be making decisions in a vacuum. And I say we're not making the decisions. Council will ultimately make the decision. But I think it's such an important step. We've never had the opportunity to give our feedback on something like this. And so I'm with you. I want it to get to as many eyes as possible. So if you guys, word of mouth, let people know, please, send them to the website so that they can vote. The email that I sent, every single business is going to be impacted differently by each of these scenarios. And so it's important that everyone thoughtfully review all of this information and decide, what they think is good for them, but also most fair to the entire business community too, or what works the best. So please, be the evangelists, go out there and share all of this information and get people to submit their feedback, because it's really important.
And is there like an end date, like a cutoff?
Yeah, I was just looking at the calendar. Yeah, so in the emails that we send out, the city and the chamber will ask that everyone vote by the May 1st, so that way we can incorporate it into the May 12th city council packet that will go out on May 6th. So thank you for that.
Is Eric still on so we can ask questions?
I believe so. Eric, are you still there? If you wouldn't mind coming to the microphone, just so everyone could hear better.
So when this study was conducted, what did we find from other cities in the comparison model to the economies of those cities when the cap was removed? And also for models 2, 3, and 4, with the supporting the outcome of the local smaller businesses, the smaller economy businesses. What happened to those? Did they increase after that? I want to know what happened to other cities so I can make a more informed decision on the different models for specifically the smaller businesses and also the bigger businesses. Did some of these bigger businesses leave after the cap was removed, for example?
Eric?
So, yes, unfortunately, in the comparison cities, most of them have not had a cap for for decades. The closest we can say is Culver City in the 2022 ballot measure did make some significant changes where they did some exemptions for small businesses. And they also added an additional tax for large businesses styled as a surcharge. The overall result there in Culver City has been continued revenue growth. Historically, I can't say this specifically for removal of caps, but historically in California, California's been a high tax, high benefit state. And so generally businesses, these taxes are so low at the margin that the tax doesn't drive people out in and of itself historically. And what I mean by so low at the margin, just if you look at a $2 per thousand rate, what we're talking about is for $100, right? It's 28 cents, right? So by the time we look at the marginal impact, generally they haven't been the reason why businesses decide to relocate if they've got a good location and they've got skilled employees and access to the right logistics and market. But I think it's wise to be careful and thoughtful about that in today's economy.
Okay, and I have one more question at this time, and I can also, if this is a bigger discussion, I can do it afterwards. In some of the earlier slides, I think it was goal number 17 in regards to okay, I'm going to butcher the word. Apportionment. How is that different across all the models? Is the same concept across all the models, or does it affect businesses differently?
That is a standard we apply now and will continue to be applied. That's not something model specific.
Same question yesterday. I was like, that is not a word. I know what that means. But basically it means the portion of business that you do in Manhattan Beach is all you're being taxed on. You're not being taxed on your gross receipts if you're doing business in multiple cities.
Right. So how is it different? Because I think in number 17, it says it addresses that there are going to be changes to that. So are we saying there's no changes to that for the future models?
There are no changes to it at all from what it currently is, which is just you're only taxed on the business that you do in Manhattan Beach.
Okay, thank you.
We're helping to clarify that that's a function of the tax. Yes.
All right. Well, thank you so much for being here.
I have food for an army out there, so please go help yourselves. Take it with you. Have a late lunch and a late dinner. Help yourselves. Thanks so much for coming, you guys. I really appreciate it.
Thank you.